Then, because the equity of the subsidiary includes preference share capital, you need a preference share analysis where you analyze the equity of the subsidiary attributable to the preference shares. Your work method will be to start with an ordinary share analysis, and any amounts that you move out of that analysis as attributable to the preference shares will move into this analysis where you attribute according to the preference share holding percentages. You will have an at acquisition section where you eliminate the at acquisition equity preference shares against what the parent was willing to pay for his investment in the preference shares and the fair value of NCI. For NCI preference shares at acquisition date, it is always measured at fair value and the amount was given. As a result, we have a total net gain from bargain purchase, which needs to end up in the consolidated financial statements. Please note, in this example, there is no retained earnings of the subsidiary at acquisition date attributable to your preference shares, because at that date, none of the preference dividends have ever been in arrears. So the only equity attributable to the preference shares at acquisition date will be their preference share capital. Now, to analyze what happened since to opening balance, we had this discussion before, but remember what happened in 29 or in the previous reporting period. You have attributed 10,000 to the preference shareholders in that 29 period, but the dividend was also declared to them. And that's why we have a zero effect. And we had that discussion and we concluded there is no consolidation journal entry necessary for NCI preference shares in opening balance, because what was attributed to them was also declared to them. So the balance of NCI should not change. And here you can see the effect in the analysis of equity. Please refer to the analysis in your textbook that was prepared on 31 December 29. It is a few pages up where you can clearly see what happened in 29 and that the effect on NCI is zero. Remember, up until this point, we work with balances, and therefore the balance on NCI is not affected. But in the current year, you see the effect again. Here we have to work with profit and dividends because we're working towards the statement of changes in equity. Here we first attribute the 10,000, which we've excluded from the profit in the ordinary share analysis. This then gets attributed to parent NCI, and you'll need a journal for profit attributable to NCI for the 6,000. And then the dividend is now the preference dividend in the preference share analysis. That is the dividend the moment it is declared. It's part of the total movement in equity of S. When it's in your analysis, you must now know that you need a consolidation journal entry to eliminate the effect. Now that we've done all the hard work with the timeline and the discussion and the analysis of equity, we can continue with the consolidation process. And the first thing we're going to do now is to go through the consolidation journal entries. We've already discussed all of these amounts. I just want to pull it together to show you why you've done all the hard work either on the timeline or in the analysis, because now you've done all the thinking, you have the amounts, and you can just write your consolidation journal entries. The at acquisition consolidation journal entry for the ordinary shares, we eliminate the ordinary share capital, the full retained earnings at acquisition date, against what the parent was willing to pay for his investment. We measure NCI, and the question said at their proportionate share. What ultimately happens is that the portion of the at acquisition equity attributable to the parent eliminates against the investment by the parent, and the NCI portion is moved out of the equity to an NCI balance. As a result, we have goodwill. Then I said we need a second at acquisition consolidation journal entry for the preference shares, where we eliminate the preference share capital against what the parent was willing to pay for his share, the investment by the parent. We measure NCI at fair value, and the fair value was given, and as a result we have a gain from bargain purchase. All of this was done in the analysis of equity. One comment to remember, and I'm mentioning this because we will get an example where it's not the case. The retained earnings at is fully attributable to the ordinary shares in this example because it's cumulative preference shares, and that preference dividend was not in arrears at acquisition date. But if you remember back to the introduction videos on chapter 8, I said that you cannot have a goodwill and a gain from bargain purchase in one group. This is a single economic entity. It's one business combination. You either have goodwill or you have a gain from bargain purchase. You can't have both. But now in the ordinary share elimination, we ended up with goodwill, and in the preference share elimination, we ended up with a gain. So what needs to happen? It needs to set off. So you need a third consolidation journal entry at acquisition date. And this journal entry that will offset the gain against the goodwill will be as follows. You had a gain which was a credit entry that you now have to debit to get rid of it, and it eliminates against the goodwill. The effect of this consolidation journal entry is that you will have no gain from bargain purchase, but a goodwill of 10,000 Rand, which is the initial 15,000 adjusted for the effect of this credit entry with the offsetting of the gain against the goodwill. So we are done with the at acquisition consolidation journal entries. The next category of consolidation journal entries is your intra-group journals, and the only intra-group transactions in this example was the dividends declared by S. We've explained the intra-group consolidation journal entry for the dividend elimination as part of the work covered in chapter 4. Please refer back to that if there's still some uncertainty. The only effect of chapter 8 is that you have a second elimination consolidation journal entry for the preference dividend declared by the subsidiary. But it's exactly the same consolidation journal as what we've had before for the ordinary dividends declared. Just a reminder, the moment the dividend is declared, you have to have this elimination journal entry. Once it's declared, it's recognized as income by the parent. Then this preference dividend and the ordinary dividend is always the actual dividend declared that gets eliminated. You are allowed to combine journal 4 and 5 and only write one consolidation journal entry, but then with the amounts from both journals added together. When you decide to do that, please make sure that you have proper supporting calculations to get to the amounts included in the journals that you've written. What you would also notice is that because the dividends was also paid by the subsidiary, we do not have that second set of intra-group journals where we have to eliminate the shareholders for dividends against the dividends receivable. The next category of consolidation journal entries is the since acquisition date consolidation journal entries, and this is where we measure the NCI balance. Journal 6 looks at the portion of the equity of the subsidiary attributable to NCI in the since to opening balance period. And the only amount we've calculated as being attributable to NCI in that since to opening balance period was the 33,000 Rand attributable to NCI in the ordinary shares. We had the discussion where we explained that there's no journal necessary in the since to opening balance period for NCI preference shares, as their balance did not change with the portion attributed to them and the dividend declared to them. Still busy with the since acquisition date consolidation journal entries where we measure NCI. We now look at Journal 7 and Journal 8 where we write the consolidation journal entries to attribute the profit of the subsidiary to NCI. You've seen these journals before. We debit the item profit attributable to NCI and we credit the NCI movement as we had a profit situation in the subsidiary. What we did there is we have from the total profit in the TB excluded the 10,000 Rand as the portion of the profit attributable to the preference shares, and that 10,000 was just moved down in the analysis, in the journal, in the timeline as attributable to the preference shares. The NCI ordinary shares is attributed at their 30% shareholding, and then this preference shareholding was at 60% for the NCI. And the moment you have these different percentages, you have to split that profit out to the equity participants. Please remember this second journal where you have to now attribute that portion, the 10,000 Rand dividend, where you have to attribute that to your NCI as well. At this point, I just want to make a comment. Please use your introduction to consolidations properly. There's a lot of explanations under each journal. With every amount, there's a little reference somewhere to the calculation, to an explanation. Use it, read through it to just improve your understanding of the work.